Good morning, good afternoon, good evening. My name is Lee Wolfram and I work in the Secretariat of the OECD's Insurance and Private Pensions Committee, or IPPC. And I will talk a little bit about what I think are some of the GSO contributions to building financial resilience to disaster risks. And I want to thank the organizers for the invitation to contribute to this discussion. The IPPC brings together representatives from ministries of finance and insurance supervisors from OECD countries and a bit beyond, with the aim of sharing expertise and experience on insurance issues. We are not the standard setter for insurance supervision, which is the role of the International Association of Insurance Supervisors. And given the makeup of our delegates, our focus is, in its simplest form, on supporting the role of insurance markets in terms of building financial resilience and contributing to sustainable development. The financial management of disaster risks, the focus of my work and my main responsibility at the OECD, is a major part of the committee's work. I should warn you that my background is economics and public policy. I'm not a scientist. You can just ask either of my teenage daughters when was the last time I was able to provide them with any meaningful help on their science homework. So my apologies in advance for referring to your work in simplistic form or in simplistic terms. It's really the only way that I understand it. So our work at the OECD is anchored in the OECD recommendation on disaster risk financing strategies. It's basically a set of guidance for governments on how to address the financial consequences of disasters, whether they be the result of natural hazards that this community works on, or the result of cyber attacks or terrorism or infectious disease outbreaks. The recommendation has three main components. Basically, the need to assess the financial vulnerabilities across society that may emerge in the aftermath of a disaster, the need to ensure the availability of financial capacity to recover from those events, with a main focus on insurance, but also taking into account credit arrangements and public compensation and financial assistance, and the need to manage risks to public finances, including the direct or explicit costs to government, such as the restoration of publicly owned buildings and infrastructure, as well as implicit costs related to responding to the needs of those facing financial hardship in the aftermath of a disaster. Critical to this is also the need for governments to assess the most effective way to allocate public funds for disaster risks, whether to risk reduction, risk retention, or risk transfer. Geosciences plays a critical role, and I would say an expanding role in this effort. As I mentioned, our guidance is anchored in the need to identify financial vulnerabilities with the ultimate aim of mitigating those financial vulnerabilities. The starting point for the identification of financial vulnerabilities is disaster risk assessment, understanding hazard exposure and vulnerability, all of which is dependent on research output from geosciences and the data and imagery of geological survey organizations. The data and imagery that is produced by the geological survey organizations is also increasingly used directly by the insurance sector. I know in a couple of the sessions before today, there was some discussion about some of the partnerships that GSOs are involved with the insurance sector. In the insurance sector, it's used both for the purposes of underwriting and for claims adjustment. So in terms of insurance underwriting for disaster risk to property, as the focus of this presentation, most of underwriting is currently underwriting is based on assessment of the hazards that could impact a given location, the potential physical characteristics of those hazards in terms of things like inundation levels or ground shaking, and the vulnerability of the structure, and then what it will cost to reinstate that insured property. The sector has developed sophisticated catastrophe models to support these underwriting assessments, although these are complicated models that are not easily updated. Data and imagery from geological survey organizations can and do make a critical contribution as a means to ensuring that the recent developments that could contribute to individual property level risk are taken into account. Think of, for example, overgrowth in a wildfire-prone area, or some form of blockage that could change the direction of water flow or water movement in the aftermath of heavy precipitation. Insurance loss adjustment or claims assessment processes are traditionally very labor-intensive, involving the dispatch of loss adjustment professionals to affected areas to assess damage and calculate restoration costs. In the context of disasters, there are huge challenges as the demand for the loss adjustment expertise surges, while damage to infrastructure impedes efficient and safe access to the impacted area. Data and imagery from geological survey organizations can and do make a critical contribution by complementing or even substituting for traditional loss adjustment expertise. So why does this matter? First of all, and this is sort of the point of this image here, is that it can help make insurance more affordable and therefore broaden access to financial protection against disaster risks. Underwriting costs account for about 20 to 25% of gross premium costs in non-life insurance, while loss adjustment expenses can add another 5 or 8%. Secondly, better information for underwriting insurance leads to better price signals for risk reduction. The cost of insurance can provide an incentive to encourage risk reduction by policyholders, and unaffordable insurance can provide a very important indication of where risks need to be reduced. Third, quicker claims payments after a disaster supports quicker recovery and ultimately reduces the economic impact of disaster events. I'm currently working on a project at the OECD that will examine how the application of new technologies, new data sources, new analytical techniques, and new policyholder engagement tools, and when I say new, I mean relatively new to the insurance sector, how the application of these technologies can encourage policyholder risk reduction. So admittedly, geosciences and data and imagery from geological survey organizations are only sort of a component of this project. But the number of examples that I'm coming across of new providers of this type of geological data for insurance underwriting and loss adjustments is almost overwhelming. I want to just quickly highlight 3 specific applications of geoscience knowledge, data, and imagery, probably familiar to most of you in this audience. First of all is addressing data gaps. This is a map of the country and regional coverage for inland flood commercial catastrophe models from 2 of the leading commercial catastrophe modeling companies. That's the companies that really create the models that are used in insurance underwriting by the insurance market and the reinsurance market. The countries in blue are the ones where there is commercial catastrophe modeling coverage. And as you can see, there's huge gaps that data from geological survey organizations can contribute to addressing, as well as modeling initiatives such as the Global Earthquake Model. Secondly, assessing the implications of a changing climate. We've recently developed a report that looks at how the insurance sector contributes to climate change, and more importantly, how that contribution can be enhanced. With a focus on contributions that it can make through climate risk analytics, the provision of risk information and adaptation advice to policyholders, adaptation incentives in pricing, as well as through resilient reinstatement. So focusing just on that first element, climate risk analytics, one of the things that we found is that the insurance sector is really only in the early stages of modeling future climate risk. That is beyond 5 years or so. And that's for a number of reasons. There's a lot of uncertainty about future emission levels, basically the success or failure of current climate mitigation policies, uncertainty about future exposure and vulnerability, what actions governments and society more broadly might take to adapt to a changing climate, as well as uncertainty about the actual impacts of climate change on the frequency and severity of extreme events. From a commercial perspective, there's also a challenge related to the short-term nature of property insurance markets, which renew annually and can be repriced annually if the level of risk is seen to rise. All of these things have limited the availability of climate-conditioned catastrophe models. And there's, of course, a huge contribution that geosciences can make to addressing some of those uncertainty elements that make it difficult for catastrophe modeling firms to assess future climate. One of the interesting things we found is that efforts by insurance supervisors to stress test the ability of insurance companies to meet their obligations to policyholders under future climate conditions is really leading to more demand for catastrophe models that are climate conditioned and for other analytical tools that support assessment of future climate risk. The last one I'll mention, which is also probably very familiar to this audience, is parametric insurance. Parametric insurance is prime for potential growth. For those who are unfamiliar, it's basically a type of insurance contract that pays out a predetermined fixed amount when a predefined parameter is exceeded. For disaster risks such as floods or storms or earthquakes, these parameters might include things like water inundation depth at the specific location, wind speed, as well as various types of measures of earthquake magnitude or even local ground shaking. Parametric insurance offers significant opportunities to expand access to financial protection by simplifying insurance and minimizing the underwriting and loss adjustment costs that I mentioned earlier that account for a not insignificant part of premium costs. Confidence in these types of triggers, which are ultimately geoscience-based triggers, also has a potential to unlock the much larger capacity of capital markets to fund financial protection, as capital markets tend to prefer transparent and independently verifiable triggers for payment. I will stop there. I hope these thoughts were of interest, and I very much look forward to the discussion. Thank you.